As we look at payroll, up until now, before this class, we have had just a bare bones journal entry with our employee being paid $800 and us showing it as an expense for the year and then paying it out. But in reality, as we're going to see, that's not necessarily the case. Where it isn't the case at all, unless you're an independent contractor or something and you hire an independent contractor, then you pay them the cash. Then they take out their own taxes when they do their own quarter, or usually at the end of the quarter and for sure at the end of the year. But as the employer, you do payroll taxes for the employee. You take their money out, you take money out of their check. And in addition, you, as the employer, have to pay extra taxes that a lot of people may not have known. As you'll see here as we go, I abbreviate employee as EE and employer as ER, just so you know what the abbreviations here are for. What we're going to do here is list the taxes that each entity here, the individual, the employee, and the employer has to pay out of their pocket. Of course, the employee gets taken out of their check, and the employer holds it for a little bit and then pays it on to the appropriate party. And then the employer has to pay an additional amount than what is withheld from the employee. For the employee, there are 4 or 5 main taxes that are taken out. The first two are paid together in one lump sum, but we separate them out to figure what's taken out of each person's check, and there's a reason we have to separate them out, as we'll see in just a minute. But the first one is Social Security. And what I expect you to memorize for this class is the percentage. This doesn't change, or at least it hasn't in a long time. We pay 6.2% out of our taxable earnings into Social Security. However, we've got to note, and we'll hit this in a little while, we'll see how this works, but it's capped at $117,000, and this is for the year 2014. Last year in 2013, it was $113,700, I believe. So every year, this number changes due to inflation. Next year in 2015, it will probably be about 120,500-ish. It may already have been released, I just haven't done the research to look at that yet. The second one that goes along with Social Security is Medicare. Social Security is what we use for, generally it's used for retirement after the age of 65 or 66, depending on how old you are. At current, you can begin to withdraw Social Security, and that based on how much money you've made over your life every year, that's how they calculate your Social Security payments. Social Security also pays for those who are disabled and they get disability income. A lot of times that will come from here, Social Security. Medicare pays for our medical insurance when we are in the retirement age of 65 plus. And this is the bare bones medical insurance. Usually most people then have this Part B and Part D for medicine and doctor visits. This one only pays for like hospital stays and some of your bigger expenses. Medicare, and what I expect you to know along with the 6.2%, is Medicare is at 1.45%. And the difference between these two and why we keep them separate is this one has no cap. You're always going to pay 1.45%. And it's more complex than this class, what we want to get into, but with the new Obamacare or Affordable Care Act, this actually will go up if you make over $200,000 in a year as a single. Married, $250,000 combined. These two combined, and that you may hear or see on your payroll checks, is called FICA. And that stands for your Federal Insurance Contribution Act. Again, that's your Federal Insurance Contribution Act. And this was designed a long time ago. I want to say in the 40s, but it may even been before that. I don't know exactly when the first Social Security was, but I believe it was in the 40s. So these two kind of go together when we're doing payroll. And a lot of times you may just see one amount, FICA, and that would be these two added up, 7.65. Your other taxes, one of the biggest ones, is your federal withholdings. This depends on how much money you make, what your taxable income is. This can deviate anywhere from 0 all the way up to 39.6%. That's a huge range. But for most of us in this class, we're going to be around the 10% bracket most of the time, between 10 and 15. So I will have to give you this because it's never set in stone. But for our class, we're going to usually assume 10%, just to make it nice, round, easy number. In payroll class, we really break this down and look at how it affects each individual and how it's different. But the federal withholdings, what do they pay for? It's always good to know what taxes go to. These go to anything that's federal related, and the biggest occupier is the military. Anything military costs. The other big things are like your interstate roads. Those are federally funded. Maybe congressman's salary. Anything that goes on at the White House or in DC generally would be part of your federal taxes. Number 4, and almost everybody will have this across the United States, is state withholdings. Now there are 7 states that don't have any withholdings. Nevada being one, Florida being another, Alaska, or just to name a few. They get their money elsewhere, Alaska through oil, Nevada through gambling. Indiana's rate is 3.4%, but we're going to just do a nice round rate in this class of 5% generally. I'll give you these two amounts just to be sure on what we're going to be using. Also in Indiana, and sometimes I'll use this and sometimes I won't in our problems, but I'll give it to you either way if I do or don't, is the county withholdings. The county withholdings, that depends on the county you live in, and it differs between 1 and 2%, but we'll say 1% is a good average. The state, what your state taxes pay would be your like your State Road 32, State Road 67. They pay for any Medicaid things that come that people get for low income health insurance type issues. So the state money definitely is a difference than the federal. And then the county pays for your local roads, government buildings in town. The city of Anderson would get some of that here in Anderson or in Muncie. And the state would give some money as well, but they're going to get their money out of these guys. After this, there's no more taxes, but you could also still have plenty of other withholdings. For example, you could have 401k, like your retirement. You could have medical premiums that are taken out because of the insurance. And there are plenty of others. Child support, maybe, garnishment. Lots of different items could still be taken out of your paycheck after the main taxes. Now, these are taken out an employee and the employer ends up paying it. But the employer also has their share of taxes that they have to pay out of their pocket that the employee doesn't really even know about. The first two are the exact same as the employee, which makes it really easy to remember. So they also pay Social Security, and they also pay Medicare. And what's even better, it's the exact same amounts. So whatever the employee pays, the employer will have to match it for both of these. The bad part about this is if you're an independent contractor, you have to pay both of these. You have to pay your portion and the employer's portion because you are the employer. You may just be employing yourself, but still that counts as an employer. Therefore, that's the bad part of being an independent contractor. You have to pay both sides. The other two taxes that the employer has to pay, one is called the FUTA, and these are very similar, and the SUTA. And these stand for Federal Unemployment Tax Act and State Unemployment Tax Act. Again, that's Federal Unemployment Tax Act and State Unemployment Tax Act. The federal that I want you to memorize, because it doesn't change very often, is 0.6%, and that's a general rate. That's what most employers are going to have to pay, is 0.6%. And this is capped at $7,000. So once the employee earns $7,000, the employer doesn't have to pay the FUTA anymore for that year. And then next year it starts over. The SUTA rate, this ranges wildly. Well, not huge wildly, but I'm going to have to give you the percent. This will range anywhere from about 0.5% all the way up to about 10%. So a pretty big jump. The state of Indiana is capped at $9,500. Some states, every state's a little different. They cap their amounts at differing numbers. We used to be at $7,000 until a couple of years ago, but when the recession hit and we had to pay out a whole lot in unemployment, that's what this fund is for, is to pay unemployment. Indiana was starting to lose money, and we actually went below zero, so they had to raise the cap so they could raise a little bit more money in the unemployment fund. Okay, given this information, we can now do a more complex payroll example. And I'll show you one, how it's worked out, and then we'll look at an example as well in class. I'll use this primary example as my main setup. And let's just assume some bare basics here. Let's assume this is the very first of the year, and we're paying our payroll now after the first 2 weeks of the year in 2014. So the employees haven't made anything yet. And as you can see, the wages are $800. And we're going to assume our typical federal and state rates. And let's even put in the county. So we'll show here that our federal withholding is 10%, and our state withholding is 5%, and let's say our county withholding is 1%. I'm not going to give you these. I want you to be able to remember that they're here and how much they are. We won't worry about anything down here now. I'll also give you this for this problem. Let's say our SUTA rate is 3%. With this information now, we can go ahead and do the 2 journal entries that are required. And there's 2 because this one is the employee and how much they made minus what taxes are taken out. And then this journal entry is simply to show the additional taxes the employer has to pay. So let's come over here and we'll do journal entry number 1 first, the employee side. Again, before it was just this. Now we're going to really expand it. So we have a wages expense of $800. And now's the point where we have to start doing some calculations, and you'll want to get your calculator. I'm I'm gonna take now $800 that I earned and multiply that by 6.2%, 0.062. And that gets $49.60. So I'm gonna abbreviate this, Social Security payable of $49.60. This, along with all the rest of them we're gonna show here, are liabilities. That's why we're doing it this week in the semester, as we look at liabilities this week and even going into some of the next week as well. This is a short-term liability. You pay Social Security quite often, along with the Medicare. Medicare payable is our next tax taken out. So I remember back, it's 1.45% times $800. I didn't do that. Let's do it one more time. 1.0145 times 800 is $11.60. Another liability. We got our federal withholdings. Another liability that we're going to have to pay, 10%. So that's a big chunk, 80 bucks. State withholdings, that was 5%. And then we have some county withholdings at 1%. If I add all of these up, that tells me how much taxes were taken out, and I don't get paid from the full 800. Our last entry here is how much does the employer actually make our check out for. They're not going to make the check out for 800. They're going to make it out for 800 minus, they're going to keep a lot of this money to pay to the government. So 800 minus 4960 minus 1160 minus 80 and 40 and another $8. I got 610 and 80 cents is what the employer would write a check out to us for out of the 800 we made. That's a big difference. Now, just like selling inventory, we're not done just after one journal. That was the employee side. We now need to do the employer's side. The employer has to pay these taxes out of their own pocket. And so, as we've always shown before, like shipping, if the employer has to pay, or the company has to pay shipping out of their own pocket, it's an expense instead of being reimbursed. So we're going to create a payroll tax expense category, and that's just a normal expense. We don't know what it is until we go ahead and add up all of the expenses all of these items that we're going to have to pay. As I said before, the Social Security and Medicare are exactly the same. So I'm going to have two Social Security payables that I'm going to have to pay as the employer. I'll have a Medicare payable. I didn't have to do any more calculation on those. That was just straight from the previous numbers. And then I also have FUTA payable and SUTA payable. The FUTA taxed at, well, I want you to remember this, is 0.6%. It's capped at 7,000. Once we earn 7,000, this is the very beginning of the year in this problem. We haven't earned anything, so we're not up near that cap yet. We've only earned 800, and so 800 compared to 7,000, we haven't hit it. So all 800 will be taxed at 0.006 as a decimal, which is $4.80. And then I tell you what the SUTA rate is. Again, we haven't hit the cap. Cap's 9,500. 800 times 0.03. It's $24. All of these taxes the employer has to pay in addition to what the employee has taken out. Now we just simply add them up to get our payroll tax expense. So I got the 24 plus the $4.80 plus 1160 plus 49.60. It came out to be an even $90 in additional money that the employer technically will pay $800 for my services. It's just that it all doesn't go to me as the employee. Only $610 goes to me, the rest of this goes to some form of tax. And then the employer has to pay another $90 in payroll taxes.